Assalamualaikum and good morning to everyone. I would like to thank all of you for joining us today for Bond Pricing Agency Malaysia's Client Briefing 2020 webinar. I would like to inform everyone that we will be recording this session today and we'll share it with you soon. And please do not hesitate to ask any questions throughout the presentation via the Q&A module. I would now like to invite Encik Mio Amri Mio Ayub, CEO of BPAM, for his welcome speech. Encik Mio.
Thank you, Bakri. Good morning, ladies and gentlemen. Assalamualaikum and welcome to BPAM's annual client briefing event. Now, this is the 14th edition of this series and is the first time that we are hosting it via a webinar format. So, ladies and gentlemen, we are going through a very interesting period, never before seen or experienced in modern times. And the effect of the COVID-19 pandemic on the economy is real, and we have yet to see how it will pan out eventually. Today, we have presenters as well as panelists from BPAM that will provide some insight on how we view the Malaysian bond market from BPAM's perspective. If you do have any questions, please feel free to post them and the panelists will try to answer them when the panel session starts. Now, to kickstart the event, I will hand over back the floor to Bakri. Thank you so much.
Thank you, Encik Mio. I would now like to introduce our two speakers for today. We have Mr. Kevin Tay, BPAM's market and economic expert, who will be presenting us fallout of COVID-19, a boon or bane for investors, and Puan Haza Borhan, Senior Manager for Institutional Clients, who will be giving us BPAM updates for 2020. I would now like to invite Mr. Kevin Tay to start his presentation.
Thank you, Bakri. Hi, good morning, ladies and gentlemen. Welcome to BPAM's annual client event. The COVID-19 pandemic, which started in Wuhan, China in late 2019, has spread across the globe in less than 3 months. In this presentation, we will look at the fallout from the COVID-19, whether this will serve as a boon or a bane to bond investors. As of recently, most severely affected countries in terms of number of cases, in no particular order, are US, UK, Italy, Spain, Russia, Brazil, China, India, and many more. In terms of casualties, US tops the chart with a death toll exceeding 120,000 so far. It remains to be seen how the final numbers are going to be as the world eagerly waits for a vaccine. Countries affected by COVID-19 also inevitably see their economies severely hit. As shown in the table here, most countries either recorded negative GDP growth for the first quarter this year or fared much worse than the consensus estimate. For instance, the first quarter GDP growth for the US is negative 4.8% against a consensus estimate of negative 3.5%. Bear in mind, this is just a first quarter GDP number. Most economists expect a much severe negative growth in the second quarter this year. For those who are sharp, yes, the Malaysian GDP did fairly well in the face of the pandemic, achieving a respectable 0.7% growth against consensus estimate of 1.5% contraction in the first quarter. That being said, we can't ignore the consensus view that almost all countries will see their economies slow down or even contract this year. It is not a question of if, but how bad. Even China has also decided not to provide an official GDP forecast for this year. The growth of 1.2% for China, as shown on the table, is a street estimate. Meanwhile, a country like the UK is expected to contract as much as 14% this year, according to the Bank of England, its deepest recession in 300 years. Central banks around the world have also taken concerted and concrete monetary measures to address the COVID-19 fallout. The Federal Reserve had slashed 150 basis points in 2 emergency meetings in March to the current level of 0 to 0.25%. The Bank of England cut a total of 65 basis points in March to the current level of 0.1%. No changes for Eurozone and Japan as they are already in zero and negative interest rate territory. Australia and New Zealand have also cut 50 and 75 basis points respectively to the current level of 0.25%. As for our ASEAN neighbors, the Bank of Thailand cut a total of 75 basis points in 3 meetings, while Bank Indonesia has cut 50 basis points so far this year. For Malaysia, Bank Negara has done a remarkable job of reducing the benchmark overnight policy rate by a total of 100 basis points since the beginning of the year to address the economic slowdown as well as fallout from the COVID-19 pandemic. Now, let's look at the balance sheet of the US Federal Reserve. Besides cutting the benchmark Fed funds rate as mentioned, the US Fed has also reintroduced its quantitative easing program, with no cap this time, dubbed as the Unlimited QE, in a bid to inject liquidity into the monetary system and kickstart the stalled domestic economy. As of today, the size of the Fed's balance sheet has already swelled to $7 trillion from around $4 trillion just before the COVID-19 pandemic hit. In less than 3 months, this is a massive 75% increase in size. Eventually, most of this money is expected to flow to the rest of the world, especially into the bond market. This will keep the bond yields at current low level for a foreseeable time. Apart from the usual monetary response from the central banks, governments all over the world have also introduced fiscal stimulus package to revive the economy. In terms of percentage to the GDP, Japan tops the chart with its fiscal stimulus accounting for more than 20% of its GDP, while the US comes in second at 13%. As you all may have already noticed, Malaysia is located at the bottom, not because the Malaysian government has not provided enough stimulus, but because its Prihatin and Penjana economic stimulus package mainly consists of loan moratoriums and other forms of indirect injections. Let's compare and contrast the COVID-19 with the 2008 global financial crisis. Firstly, the COVID-19 has become a pandemic and public health issue as compared to the global financial crisis, which originated from the subprime loan crisis. Secondly, almost all economic sectors and countries are not spared this time due to the lockdown or movement restrictions imposed to contain the spread of the COVID-19. Thirdly, unprecedented stimulus packages were introduced in terms of size and reach. And finally, it is not easy to be overcome by government's fiscal policy or central bank's monetary policy. This is also the reason why governments and central banks around the world chose to do more rather than to do just enough. Taking a look at the state of the Malaysian economy, surprisingly, Malaysia's GDP has fared much better than many would have believed. However, inflation as measured by the Consumer Price Index in April slumped to a negative 2.9%, the lowest level recorded in a decade since 2010. Meanwhile, unemployment rate has surged to 3.9% in March, the highest level since June 2010, which recorded at 3.6% unemployment rate at the time. The high unemployment rate in March reflects the negative impact of the Movement Control Order, or MCO, on the labor market. Then we have various forms of the MCO, which has been extended until 31st August, and for which we are currently under the recovery phase. It is fair to say that the MCO has managed to contain the spread of the COVID-19 in Malaysia, laying the foundation for the economy to reopen. So far, the Malaysian government has announced a total of 295 billion ringgit of stimulus package under the Prihatin and Penjana initiative, in which 45 billion ringgit is a direct fiscal injection. This will increase Malaysia's fiscal deficit to between 5.8% and 6% of the GDP, which is deemed necessary at this crucial time when the country is facing adverse economic conditions. Bear in mind, This is not the highest fiscal deficit in record for Malaysia, as we recorded 6.7% back in 2009 during the global financial crisis. There are also talks in town that the Malaysian government is planning to request state-owned entities like Bank Negara, Khazanah, Petronas to pay higher dividend in 2020 to fund the fiscal deficit. Petronas paid the government 24 billion ringgit in regular dividend and 30 billion ringgit in special dividend in 2019. It was also reported in February that Petronas was going to pay 24 billion ringgit in regular dividend to the government this year as well. To date, the Finance Minister Dato Sri Tengku Zafrul Abdul Aziz said the government has no plans to seek special dividend from Petronas this year. This is considered a prudent approach as global crude oil prices have just recovered from its lows early this year during the peak of the COVID-19 pandemic. Additionally, they are also caused by certain parties for the government to reintroduce the Goods and Services Tax or GST of 3% than the previous 6%. Judging from the current situation, Malaysia is most likely to breach the debt to GDP ratio cap of 55% this year. The government will have to seek parliament approval in raising the legal cap. Meanwhile, the Malaysian economy is also highly integrated with the global supply chain and thus susceptible to global supply chain disruption brought on by the COVID-19 pandemic. Recovery in global demand may take several years, and consumer spending pattern and behavior will not normalize almost immediately. As for business investments, it all depends on the pace of the economic recovery post-COVID-19. As mentioned earlier, the Malaysian CPI recorded a multi-year low of negative 2.9% in April. This makes Malaysia one of the highest yielding countries in the region in terms of real interest rate, when the OPR was still around 2.5% before Bank Negara reduced it to 2% in May. Despite the reduction, the Malaysian real interest rate is still relatively high considering the current state of the economy. This gives Bank Negara ample room to possibly cut the OPR once again in near future. Now let's look at the Malaysian ringgit exchange rate versus the crude oil prices. As you all can see, the ringgit has been trending lower since beginning of the year when the COVID-19 outbreak was first reported in China. The crude oil market tumbled almost immediately as market participants were worried of the economic repercussions brought around by the COVID-19 due to the travel restrictions and lockdowns introduced by many countries. The Malaysian ringgit also tanked against the US dollar as Malaysia is still dependent on oil revenue, albeit at a lower proportion. That said, the Malaysian ringgit has already rebounded from the lows in recent months as global crude oil prices started to regain its ground. As to whether the recovery is sustainable, this will depend on the stance adopted by the Saudi Arabians and the Russians. In terms of the MGS foreign holdings, despite seeing foreign holdings trending lower since February, it has since hovered around 36% as of April. Foreign holdings of MGS is expected to stabilize around this level as Bank Negara is expected to intervene in the bond and forex market to prevent the foreign outflows from getting out of hand. This is similar to Bank Indonesia's approach of intervening in the sovereign bond market as one of their tools to stabilize the depreciation of the Indonesian rupiah and to support the government's financing needs. If we look at the May Mpc statement released by Bank Negara, outright purchase of government securities was specifically mentioned as one of the tools to provide additional liquidity into the domestic financial markets. In fact, Bank Negara holdings of the government securities papers has quadrupled to 1.2% of the total outstanding in April from just 0.3% in March. Bank Negara also mentioned that they will continue to monitor the outlook for domestic growth and inflation. They will utilize policy levers as appropriate to create enabling conditions for a sustainable economic recovery. Now let's look at the ringgit bond market performance as tracked by TR BPAM All Bond Index. We may have already noticed that the bond market performance of an 8.72% gain in 2019 was nothing short of spectacular. Despite the initial dip to the previous year's level in March due to the MCO and the fear of global COVID-19 spread, the Malaysian bond market has successfully charted a V-shaped recovery has already gained more than 4% year to date. Considering the dovish stance by Bank Negara and other central banks around the world, interest rate environment and bond yields are expected to stay low for at least 2 years until end of 2021, when the COVID-19 vaccine is expected to be developed and economy is expected to fully recover from the COVID-19 fallout by that time. This will bode well for the bond market in near future. Owing to the ultra-dovish monetary policy adopted by major central banks, the spread between the 10-year MGS and sovereign yields of other countries have increased recently as represented by the green lines. This shows that our MGS yields are relatively high as compared to other countries in the face of the pandemic. The same phenomenon is observed for the corporate bond market. Credit spreads for most of the credit classes have increased over the past few months due to the risk-off sentiment. We can't deny the fact that most business segments will be affected, but generally, when the economy is fully reopened, credit spread is expected to revert to mean. Despite the setback of COVID-19, the bond market continued to grow steadily this year. The total ringgit bond outstanding has already exceeded 1.54 trillion ringgit as of May. This represents a growth of 4.1% compared to the same period last year. As the Malaysian government is expected to finance its enlarged budget deficit this year via the bond market, the total MGS and GRI outstanding amount is expected to trend higher from now. For the overall monthly trade volume and turnover ratio, it is still relatively flat, but we did see a slight increase in the MGS segment during the volatile period in March and April this year. However, it has since normalized. All in all, we should remain cautiously optimistic over the bond market performance this year due to the following factors. First thing that comes to mind is Bank Negara's outright purchase of government securities. Bank Negara may become the buyer of last resort to keep bond yields low. Bear in mind, they still have plenty of room to cut the interest rate should our economy deteriorate further, before introducing extraordinary monetary policy measures such as asset purchase programs or yield curve control mechanisms, although it is still relatively early to say. Secondly, the COVID-19 vaccine could be discovered much earlier than expected as countries around the world race against the clock and each other to develop the vaccine. Finally, corporate bond credit spread may trend lower when the economy has fully reopened. That being said, bond investors should remain vigilant as crude oil prices may not reach the pre-COVID-19 level of around $65 per barrel this year as new normal kicks in. People are talking about cutting air travels and working from home permanently these days despite seeing reduction in new cases lately. Meanwhile, the Malaysian sovereign rating may also be subjected to rating downgrade due to the enlarged budget deficit. Thirdly, not to forget, Malaysia is still placed on the FTSE Russell's World Government Bond Index watch list. The next factor is the domestic political development. And finally, investors should also brace for a deteriorating US-China relationship. Since the month of July is just around the corner, let's look at what is in store for us in the second half of 2020. First and foremost, investors are concerned as to whether the much hyped second wave or the subsequent wave of COVID-19 is going to happen. Secondly, the question as to whether there will be a V-shaped recovery once the vaccine is found and the economy is fully reopened. Thirdly, of course, is whether the crude oil prices recovery is sustainable or just a short reprieve. The next concern, as mentioned earlier, what will be the new long lifestyle change entails? Also, the deteriorating US-China relationship, Will this lead to the new Cold War of the 21st century? Lastly, it is anyone's guess as President Trump heads towards the November presidential election to seek his second term in office. That's all for my presentation today. Thank you, have a nice day, and stay safe. Back to you, Bakri.
Thank you, Kevin. From Mr. Kevin's presentation, we can see that the Malaysian bond market is going to perform remarkably well this year in the face of the COVID-19 pandemic, due to the dovish stance adopted by Bank Negara, as there is still plenty of room for Bank Negara to cut the benchmark interest rate amid the current challenging economic conditions at home and abroad. I would now like to invite Puan Haza Rina Borhan to present to us BPAM updates for 2020. Puan Haza.
Thank you to our host, Mr. Bakri, for your introduction. Assalamualaikum and a very good morning, ladies and gentlemen. Firstly, I would like to thank everyone for participating in our 2020 client briefing. Every year, we hold client briefing to update clients on current and future developments. However, given the current situation, this now has to be done online, and this is in fact the first online client briefing by BPAM. Therefore, we are honoured by the response we receive. BPAM always ensure that our customer service provide assistance in every aspect of our services. To this end, client can be rest assured that they will always be able to contact us, and we will respond to every email and call as soon as possible. My presentation for today is on what we have developed and what we plan to do for year 2020. This will include our latest data and service, which are Unrated Bond Index and MFRS 17 Support Pack. This will be followed by the Bond Stream version 10.0 enhancement, and I will also touch on the enhancement of our mobile application IBPAM. Last but not least, I will be updating on our new enhancement for security protocol. Therefore, I request your kind attention and patience throughout my presentation. Without further ado, let's go to the first agenda. This is great news to insurance companies. In support of the MFRS 17 requirements, we are now ready to provide the discount rate data. Although we know that IASB will decide on a new effective date for MFRS 17 by January 2023, we trust some of the insurance company will lack an early adoption in implementing MFRS 17. Hence, we have already generated and are ready to provide data for MFRS 17 in consultation with the Actuarial Society of Malaysia, ASM Working Group. Here are details of the MFRS 17 support pack. We will provide the risk-free rate and forward rate data from tenure of 1 year up till 100 year. The data will be updated on a daily basis. The delivery channel is through our application BondStream. To find out more on the subscription, please feel free to contact your relationship manager. Let's move on to the screen for MFRS 17 on BondStream. Users will be able to see the risk-free rate and forward rate under the data tab, and user can filter by principal, conventional or Islamic. User will also be able to see the chart for risk-free rate and forward rate under the chart tab. To find out more on the approach we use to determine the discount rate, user may download the MFRS 17 document from the screen. We now move on to the BPAM Unrated Bond Index. Before I introduce our new index, let me explain a little on our journey as an index provider. We started with the BPAM Bond Index in 2009. In 2011, we co-branded the index with Refinitiv, or previously known as Thomson Reuters, and call it TR BPAM Bond Index. We too are the calculating agent for TR Global Suku Index. In 2018, together with 2 Asian countries, Indonesia and Thailand, we came up with the A3GBI Index. Last year, we launched the ESG Bond Index in Malaysia. Not only that, we are also capable to develop customized index based on clients' requirement. This year, we are proud to provide the BPAM Unrated Bond Index, and it will be on free trial basis for all BondStream users. If you currently have or plan to have unrated portfolio, this information will be valuable for you to track the performance of your unrated pool. Therefore, we hope users will take this opportunity to explore the unrated data And if you have any question, please do not hesitate to contact us. BPAM Unrated Bond Index covers Malaysian Ringgit denominated long-term unrated conventional and Islamic bonds. As at 31st March 2020, the index consisted of 134 bonds. The unrated index data is backfilled to 2nd January 2015. We review and rebalance the unrated index on a daily basis. Currently, the delivery channel is through our bond stream. Now, I will show the screen for the unrated bond index. Existing index customer will be more familiar with our index screen. For the unrated index, it is a drop-down from the existing index screen. The unrated index level can be obtained from the bond index headline screen. From this screen, user may filter by period, principal, or aggregate to see all unrated indices which consist of financial, corporate guarantee, and corporate. User may also filter by financial only, corporate guarantee only, or corporate only. You can click on the index document for more information on the criteria for inclusion and exclusion. To get the composition, user may click on the index value or go to bond index composition screen. Bond index statistics screen will show all bond index classes for unrated bonds, and bond index performance screen will show the simple return from 1 day, 3 months up to 1 year and annualized return. You can also use the bond index chart screens to generate chart for your reporting purposes and run some technical analysis. If you have any question or would like us to make a presentation on the technical aspect, please do let us know. We can make the presentation via con call. Next, let's move to the next agenda. Every year, we will enhance our application bond stream to improve and provide more data to our users. This year, we will release the bond stream version 10.0. We target to launch the bond stream version 10.0 on 6 July 2020. As always, we will send a notification together with the bond stream link on the day we launch. We encourage clients to upgrade to the latest version to benefit from the latest enhancement and data. We understand that some organizations may not be able to download the bond stream link due to firewall restriction. Hence, please feel free to contact your RM to obtain the installation CD. Here is the enhancement list for bond stream 10.0. I will not go through every single enhancement, but we only show the new screens that will be available in bond stream 10.0. The full enhancement list will be provided in the notification email. So what are the new screens? First, we have NAV calculator screen. This screen will allow users to calculate NAV for their bond portfolio. To do this, users will have to save their portfolio into the favorite bond screen first. After saving the portfolio, user will have to import the saved portfolio into the NAV calculator screen. You don't have to worry, as your portfolio will be saved in your local drive and BPAM will not know what your portfolio is. Once this is done, user may select the date and will have to key in the nominal value in MYR million. Click Go to calculate the NAV. On Liquidity Tracker, we have received feedback from users that they would like to have a liquidity screen where they can input their own weightage. Therefore, we have created a new screen called Liquidity Tracker User Input Weight. On this screen, user may key in their own weightage for trade recency, trade frequency, and trade turnover. The composite liquidity can be obtained by bond, facility, and issuer. Previously, we only had Liquidity Tracker by bonds. For bond stream 10.0, we have added new screen which are Liquidity Tracker by facility and Liquidity Tracker by issuer. With this enhancement, we hope this will assist user in analyzing liquidity in terms of not only by individual bond, but by facility and issuer as well. Liquidity Tracker screen are available to all rated bond pricing clients. We hope user will explore the data. Next is multi-asset chart screen. This screen will allow user to plot a chart to make comparisons between bonds, equity, and unit trust NAV. This new screen is under local markets multi-asset chart. The last screen is volatility info screen. Users will be able to see the volatility of specific bonds from 1 week until 1 year based on user's selected date, and user may select up to 5 bonds. The volatility value is calculated by using standard deviation formula. To find out on the formula, user may download the document from the screen. BPAM mobile application, iBPAM. iBPAM is our free app which provides information on latest daily trades and market summaries such as bond schedule, YTM metric, YTM charts, and other related bond data. We gave our website a total makeover last year. Subsequently, this year, we will be revamping our iBPAM application to change its looks and feel, and to have more charts and data, as we understand that technology on the go is important to provide information speedily and timely at users' fingertip. We are also planning to broaden our data in our mobile apps in the future. For instance, we may develop mini bond stream for selected data. What is your view about it? If you have any suggestion on how to improve our mobile apps, please feel free to share with us. We welcome all feedback. To those who have never viewed this app, please download from Google Store or Apple Store and do let us know your comment about it. My last agenda is on our new security protocol. Security is always our top priority. As part of our effort to provide a safe environment for our user, we will be implementing a new password requirement for our platforms, BondStream and website. This will be implemented on 16 October 2020. Rest assured, we will provide at least a 2-month notice to all users. We will give a 1-month grace period from the implementation date for user to change or update their password. We understand that user may be sharing the ID with their colleagues or other department. Therefore, we hope you would share this information with your staff or colleagues. The new password requirement will be provided in the notification emails. That's all from me. Before I end my presentation, I would just want to assure all of you, even we can't interact with our client face-to-face for meeting, we at BPAM will always assist you. If you would like to have a product presentation or BondStream training, we can always do it through video call. Do feel free to contact your RM. Thank you, and if you have any question, please ask during the Q&A session. Back to you, Bakri.
Thank you, Haza. To summarize what Haza had presented earlier, BPAM will launch 2 services this year. First is the MFRS 17 support pack, and second is the BPAM unrated bond index. The new enhancements will be our application BondStream 10.0 and iBPAM app. In addition, there will be a new password requirement that will be implemented in October this year. Now is our Q&A session. Joining our 2 speakers today are Ms. Hugh Suling, BPAM's Head of Pricing, and Puan Nur Bazlina Sharifuddin, BPAM's Head of Financial Engineering and Research. Okay, Mr. Kevin, we have a few questions for you.
Okay, yes.
First question. How low will Bank Negara Malaysia cut the benchmark OPR in view of the current economic condition? And do you think ringgit bond market will outperform last year's performance?
I think whether Bank Negara will, how low will Bank Negara reduce the benchmark interest rate, all depends on how bad the Malaysian economy is going to be. If Malaysian economy is faring much worse than expected, I think Bank Negara will cut at least another 50 basis points this year. And whether the bond market will perform better than last year, I think also depends on Bank Negara, whether Bank Negara will cut 50 basis points or more. If Bank Negara maintains status quo, I think the may not be doing much better than last year, our bond market. That's all, Bakri.
Thank you, Kevin. We have another question for you. What is the total percentage of foreign holdings of Malaysian securities, Garveys and corporates?
Okay, in terms of foreign holdings, overall, the combining both corporate and sovereign holdings, I think is around 12%. If just for MGS and GII, the foreign holdings is around 21%, if I can remember correctly. Thank you, Bakri.
Thank you, Kevin. Okay, next we have two questions for Puan Bazlina. Okay, first question. What is your MFRS 17 methodology? And is this MFRS 17 product from BPAM endorsed by MASB or Bank Negara Malaysia?
Hello all, thank you for the question, Bakri. So the questions were about MFRS 17, the methodology, as well as if it is endorsed by MSB or BNM. Okay, I'll answer the two questions together. In developing the methodology for MFRS 17 support pack, we are actually in constant contact with ASM, and that is the Actuarial Society of Malaysia. So they have a working group that specifies research on the best way to comply to the standards, and they are actually in contact with BNM to propose a methodology that is best adopted by the insurance and takaful companies. So to say that is it endorsed by MSB, we don't really have contact with MSB, but we do have contact with BNM through ASM. So together, BPAM, ASM, as well as BNM have been talking to each other to see to come up with a methodology that would suit everybody. In terms of the methodology, there's actually another question at the bottom. If we use bottom-up or top-down approach, so we use the bottom-up approach. And about methodology, short answer, we use Smith-Wilson. What you will get is a curve, MGS and GII curve from 1 year to 100 years. So it will be extrapolated using Smith-Wilson methodology. So our methodology is actually based on BNM's exposure draft on valuation of insurance and takaful liabilities, which they published on 24th December 2019. In that exposure draft, for the discount rate of valuation for insurance and takaful, which is what MFRS 17 is partially about, BNM prescribed the way to generate a 100-year curve. There's 3 segments to the curve. The first segment is 1 year to 15 year, where you use market data, and 15 year to 60 years, segment 2, you extrapolate using Smith-Wilson, and they also give the parameters to this methodology, the alpha, the long-term forward rate, to extrapolate to 60 years, and then the segment 3, 60 years to 100 years, is you calculate the spot rate to get long-term forward rate of 5%. So the whole methodology that we do, our MFRS support pack, is following this exposure draft by BNM. This exposure draft is for valuation of insurance and takaful liabilities, which as I said, matches MFRS 17. And yeah, it uses bottom-up approach. I think that's all I have for MFRS 17, Bakri.
Thank you, Bazlina. Mr. Kevin, we have 3 more questions for you.
All right.
Very popular today, huh? Okay. Do you think this year's GDP will be lower than Bank Negara's forecast of -2.0 or plus 0.5%? Why? Okay. That's the first question.
Okay. I think the 2020 GDP for Malaysia will be much lower than the initial Bank Negara forecast, due to the fact that the initial forecast was done at the early stage of the MCO, and then, as we all know, the MCO has already been extended a few times until 31st August now. So I think the Bank Negara initial projection of -2 to +5%, 0.5% will be much worse I mean, by end of the year. So anyway, I think Bank Negara will revise their own GDP forecast once the second quarter GDP numbers are out. Bakri?
Thank you, Kevin. Next, would the breach of 55% ceiling cause a downgrade of Malaysia's sovereign rating and negative rating on Malaysia? How will this affect USD MYR?
Okay, thank you, Bakri. I think if our Malaysian government communicates better with the international rating agency, our rating should be able to hold around the current level, which is A-, because even at 5.8% deficit or even 6.0% deficit is still much lower than the 6.7% deficit back in 2008 during the global financial crisis. I think even during that time, our international credit rating was able to hold. As for whether the downgrade will affect our ringgit, I think definitely yes. If international rating agencies really downgrades Malaysia credit rating, I think our ringgit may have to depreciate further from where it is now. Thank you, Bakri.
Thank you, Kevin. Okay, the next question is for Ms. Q Suleng. Are your current processes and methodology for bond fair valuation affected by the lack of secondary market trading and liquidity?
Thank you, Bakri. Good question. I'm quite sure everyone is bothered by the liquidity conditions of the bond market at the moment. Although we see the lack of secondary market trading in the bond market, we still have a sufficient amount of pipeline issuances and sufficient trading for the more liquid papers in the market, which we use to derive and imply the levels for the less active papers. So the methodology stays as it applies to all conditions, and lack of liquidity is not a new thing, not just for this current COVID-19 pandemic. It has happened before, and the methodology remains sound through all these times. So I hope that answers your question.
Thank you, Suleng. Mr. Kevin, we have three questions here for you.
Okay, sure.
First question. Is there any risk related to corporate bond sites as companies have just started to reopen back to full capacity? That is the first question.
Okay, thanks, Bakri. I think definitely as a bond investor, we should always be aware of the risk associated with the bonds you are invested in. But as we all know, most of the bonds in our ringgit bond market are actually project financing related or infrastructure related. So in terms of risk compared to the stock market, I think it will be relatively contained because all these project financing bonds actually they already budgeted the cash flow and it should be much better than the stock market, I would say, in terms of the performance. That's all, Bakri.
Thank you, Kevin. Okay, next question. Yeah. Do you foresee further volatility in the ringgit bond market for the rest of the year?
Yes. As a bond investors, I think we should always brace for heightened volatility at any time because we really don't know what will happen around the world. I mean, out of sudden, maybe there is some rocket being fired around somewhere in the world, maybe in North Korea or Iran or somewhere else. So we really don't know. So even the US presidential election in November, we still don't know who will win. So this may create a lot of uncertainties. So I think for bond investors, we should be always prepared for this kind of uncertainties and brace for the volatility. Bakri?
Thank you, Kevin. And the last question for this round of questions for you. What are your expectations with regards to foreign holdings of MGS? Is it going to increase or decrease?
Okay, thank you, Bakri. As for the foreign holdings for the MGS, at the current 36%, I think it should be able to hold well because of the current quantitative easing program by the US Federal Reserve. Because as I mentioned in the presentation just now, the US Federal Reserve balance sheet has already increased 75%. So in less than 3 months or around 3 months. So that is a massive $3 trillion increase. So ultimately, I think some of the money, or if not most of the money, will flow to the rest of the world. So if Malaysia sovereign yields remain high, I think some of the money will come into our sovereign bond market. So that will bode well for our MGS foreign holdings. Thank you, Bakri.
Thank you, Kevin. Okay, the next two questions are for Puan Bazlina. Okay, the questions are, what is the percentage of unrated bonds covered under the unrated bond index versus the unrated bonds pool in the market? And what is your inclusion rule for unrated index?
Thank you for the questions. I'll answer this together as well. Inclusion rule for unrated bond index first. So unrated bond index covers conventional and Islamic bonds with fixed rate coupon, meaning the bond type included in the index are discount bonds and fixed coupon bonds, including bonds with secondary notes. Bond outstanding amount has to be 50 million and above, and the bond has to be at least 3 months during index calculation. So these inclusion rules are the same with our rated bond index actually. And the methodology as well is the same. Inclusion exclusion rules the same applies for unrated and rated bond index. As for the other question, what is the percentage of unrated bonds covered in the index versus unrated pools in the market? As at first quarter 2020, 31st March 2020, there is about 10% of unrated bonds in the index, which actually makes up about 50% of market cap. So 50% market cap of unrated bonds is inside the index. Hope that answers the question.
Thank you, Bazlina. Okay, next we have a question for Ms. Suling. Normally, how fast would the bond yield reflect the OPR cut once it is announced?
Okay, thank you, Bakri. Well, the reaction of the yield curves and all the bond yields to an OPR cut really depends whether the quantum of the cut and the cut itself has been priced in by the market. If it has already been priced in, like what we have seen recently, there will be minimal movements, and usually it happens within the same day or the next day. And if it has not been priced in, of course, there will still be time needed for the market to digest that rate cut action. And this again takes about just 1 or 2 days for the market to digest and for yields to react. So that's my rule of thumb reply, but of course that isn't always necessarily the case. It depends how active the market has been and how much the market has that it lacks the news. So that's all I have.
Thank you, Suling. Next, we have a question for Puan Haza. With all the new enhancement and features on BPAM, will it remain free for all?
Thank you, Bakri, and thanks for the question. Currently, the BPAM is free to clients and public. With the new enhancement, it will be additional platform for the client to get our data. Hence, we will not charge additional costs for the client. So do explore the application. That's all from me.
Thank you, Haza. Okay, we have two questions here for Mr. Kevin.
Yes.
Okay, first question. Do you anticipate US interest rate will move to negative zone if the economy worsens further? And when is the next review by FTSE Russell?
Okay, let me answer the first question first. I think already mentioned a few times by the Federal Reserve Chairman, Jerome Powell, that Federal Reserve, they don't really intend to move the interest rate to the negative territory. I think because of what they can see from the Japan experience, so it's not a really effective tool to move the interest rate to the negative territory. But I think there are also talks in the market now that they may introduce yield curve control. So whether they will introduce yield curve control or not, I think let's see in the next few the monetary policy meeting. Yeah. What is the second question again?
When is the next review by FTSE Russell? Hello, Kevin. When the next question is, when is the next review by FTSE Russell?
Sorry, but can you please on your mic?
Kevin, when is the next review by FTSE Russell? Okay, it's okay. We'll be going to the next question, which is for Ms. Suling. How will BPAM pricing be performed when rates are negative?
Okay, thank you, Bakri. Well, if rates become negative, and I hope that's not the case, well, our calculator can still cater for calculation of conversion of yield to prices, even when it's negative. As for the pricing methodology, it still goes by a spread to MGS regardless what yields it is going at. And that's all I have.
Okay, we'll be going back to Mr. Kevin.
Yes.
Okay. When is the next review by FTSE Russell?
Oh yeah, that was the question just now. Yes. Okay, I think if I'm not mistaken, the next review will be in end of September or early October. So by that time, we shall see whether we are still being placed on the watch list or being lifted from the watch list. So we will see. That's all, Bakri.
Thank you, Kevin. Okay, we have one question here for me. Will you be sharing the slides of the presentation? Yes, we will be sharing the slides of the presentation with the recording of today's session as well. We will now be waiting for a minute or so for any new questions for this session. Okay, ladies and gentlemen, that's it for the Q&A session. I would now like to invite Encik Mio once again for his closing speech. Encik Mio.
Thank you so much, Bakri. On behalf of BPAM, I would like to express our appreciation to all of you for making time to participate in this event. I hope the event has been beneficial to you as it was for us. Well, we have heard the Malaysian bond market is resilient. it will be an important source of capital as part of the broad economic stimulus package currently being put in place by the government. As stakeholders, we have a duty to ensure that the market is as efficient as it can be to maximize the benefit of raising capital through the bond market. If we can introduce changes that maximizes efficiency, whether big or small, collectively the market will gain. Remember, if you guys recall, 3 years ago, the buzzword was IR 4.0, Industry Revolution 4.0. Today, the buzzword is new normal. See how fast the things will change within the space of just a couple of months. Whatever name given, one thing is for sure, change is inevitable. We can either embrace it or we get swept away by it. So with that parting note, once again, thank you so much for participating in the event. Back to you, Garvey.
Thank you, Encik Mio. Before we go, I would like to remind everyone that we will be sharing the video recording of today's session and the presentation slides. And if you have any further questions, please do not hesitate to email us at enquiries@bpam.com.my. So before we go, stay at home, stay safe, stay healthy, and take care of yourselves. Thank you.